Hey everyone, and welcome back to another video for today. In today's video, we're going to have a look at the current state of the market. At the time of recording, things look quite okay across the board, but I do want to focus on one specific company. One company that, of course, is in charge of everything that's happening in the market, whether we like it or not, especially when we talk about AI, semiconductor, tech companies. And that, of course, is NVIDIA. Now, NVIDIA is a company that is the most valuable one on the planet, yet the stock has not done anything over the past 6 months. And so in today's video, let's have a look at the company, pricing, compare it to AMD, of course, DCF, base, bull, and a bear case to better understand what is priced in, what is not priced in at the moment. And of course, all of the DCFs are available to you for free. There is a Google Drive link down in the description and in the pinned comment. And so right now, if you look at the market, this is basically it. We like to see this. Now you might see, okay, Micron is down 4.5%. It's actually back to $377 per share. What is going on there, right? We just had an amazing quarter, good guidance as well. Well, it has more to do with what Google is releasing, TurboQuant. It's a way to make sure that, well, you can run AI inference in a much more efficient way, in a way where you might not need that much memory or expensive HBM, high bandwidth memory, that SK Hynix, Samsung, and Micron is selling to all of these big tech players. And of course, that has a negative impact right now on Micron. Maybe I'll do a specific video talking about that, the impacts of it on Micron, SK Hynix, Samsung, and also all the other players. As for the rest of the names, we have AST and Rocket Lab that are up 10%. Intel is up 7%. Robinhood is up 6.5%. They are increasing their share buyback program to $1.5 billion, if I remember correctly. And then all the rest here, you can see nice green. We do have some red names, as always. Like we said, Micron is red. Still, ServiceNow is red. HIMSS, Rubrik, Shift4, Salesforce, Oscar Health, United Health, Adobe, Novo Nordisk is actually under $40 per share. Root is down, and Nebius is down 0.2, Google is down 0.2 as well, and then Zeta is basically flat. Now, let's talk about NVIDIA, because as you can see, over the past 6 months, this is a stock that has done absolutely nothing. Over the past 6 months, it's up $1.40 or 0.8%. Year to date, it is down 5.2%, and over the past 12 months, it's still up 48.4%. Of course, over the past 3 years, it's up 575%. But let's have a look at the company itself. We are looking at a company worth $4.3 trillion, a trailing PE 36.3 times, but a forward one that is much lower than that. It says here 24.2 times, price earnings to growth ratio 0.5, so under 1 is by definition undervalued, unless of course we don't trust the forward-looking expectations. But if we look at the forward-looking pricing multiples, for example, if we look at this one right here, forward price to earnings, so forward PE, 21.4 times for this company. It's not expensive in my book. Price to sales is always going to be high compared to all the other players out there. 11.5% forward price to sales. Yes, this is because currently operating margin for this business is of course very, very high, around 60% or so. And then when you look at the price to free cash flow here, again, trailing 12 months, 45.2 times. Now, some of it might seem expensive to you, but when we have a look at the margins for this business, whether it's operating margin, free cash flow margin, gross profit margin, EBITDA margin, or net profit margin, you cannot tell me that this is not a company that deserves to trade at these types of multiples. Of course, as you know, we are not buying what has happened before. We are buying what we are expecting or trying to predict what will happen in the future. And currently what the market is trying to tell us is that, okay, right now, insane margins, operating margin 60%, free cash flow margin 44.7%, gross profit margin 71%, etc., etc. And by the way, all of this is available to you on fiscal.ai. There's a link down in the description, and in the pinned comment, you'll get 15% off if you use it. And if you are a new user, you'll get 2 weeks of Fiscal Pro for free. So do try it out. You'll get everything that you see here in each and every video. Now, the market is trying to say everything looks great with NVIDIA. Everything looks insane with NVIDIA over the past 3 years or so. But what's to say that all of this will continue for the upcoming years, right? Despite us looking at the expected growth, the guidance and everything, they all look quite good. The market still does not believe it, or at least it's telling us, you know what, even if it happens, we would like to play it safe. Because if we look at the expected growth, right, we're looking here at $369.4 billion in revenue for fiscal 27, then $479.9 billion in fiscal 28, and then $561 billion in revenue for fiscal 2029. So yes, it's still expected to grow. It might not be growing as fast as before, which is normal when you're looking at the dollar amount here. That's completely fine. Also, who says that they are going to command these types of margins for the next couple of years? Okay, fair enough. This is why I'll show you the DCF, the bull, the base, and the bear case, and you'll see where we stand. Now, to better understand what's going on, let's have a quick look at CapEx and expected CapEx for the upcoming fiscal years. As you can see, for fiscal year 26, we're close to $600 billion, just looking at Amazon, Google, Meta, and Microsoft. That's expected to continue to grow in fiscal 27 and fiscal 2028, but you can clearly see here that CapEx growth is slowing down as expected. Now, more recently, we've had, of course, a GTC. Jensen said, and he doubled his previous estimates, projecting $1 trillion in AI chip demand by 2027. The demand is split roughly 60% among hyperscalers and 40% across enterprise and sovereign cloud. Remember, this CapEx number right here, close to $600 billion, is purely talking about just 4 companies. You have hundreds of other companies around the world. You have, of course, countries that are spending an insane amount of money as well. And so when we have a look at what we see in a Bloomberg terminal, for example, well, yes, the expectations were quite close to this number right here, the $1 trillion number through 2027. And so that's why the market was maybe not as shocked or surprised by that number. But it is important to note that they also said that it's going to be at least $1 trillion, and he's made it quite clear that they are probably going to be quite conservative with that number. Now, before continuing with this whole GTC announcement, AMD comparison, and Grok with a Q, let's have a look at the DCF. All right, so in short, this is basically it. You've got the current stock price, and then the bull, base, and bear case implied price. If this is the only thing that you need to see, this is basically it. Bull case here, upside 74.4%, base case close to 19%, bear case 36.6% downside, and the probability weighted price sits at close to $225, which represents around 25% upside. I'm putting 50% probability on the base case, 20 on the bear, and 30 on the bull. Could be much higher, right? You can do whatever you want with these numbers. That's the whole point of a DCF. And so the assumptions are all of these things right here, but let's look at the projections itself for each and every case here. So let's start off here with the bull case. The growth rates for revenue in the first couple of years, it's basically based on what the market is expecting right now, adding a little bit more bullishness. And then yes, the growth, of course, is expected to come down. Maybe it is coming down a bit too aggressive for your taste towards the end here, but don't forget that we are going to start to deal with trillions of dollars in revenue, and so I'm not expecting a company to generate over $1 trillion in revenue to be growing 20%. Now, in this case, EBIT margin, they can sustain what they're seeing right now and actually maybe even become a bit better. So we're seeing here it's be sustained at around 65%. And this brings us to a free cash flow to the firm margin of around 54%, 54.5%. So that's the bull case. And I think for a bull case, it's quite reasonable. Some people will probably say, no, it doesn't make any sense. Again, there is a link to this in the description and a pinned comment. You can go and play around with it. It's free. You don't need an email, Patreon, whatever. Base case. Here as well, I'm basing myself in the first couple of years on the analyst expectations. And then, yes, a gradual decrease in the growth rates. With EBIT margin, I am a bit lower than the bull case, which makes sense, but still a little bit better to what we're seeing right now, because I think that the company, yes, with the software, with the investment, with inference, I do think that they can sustain these types of margins So I'm putting this at 62%. That's going to be flat and stay around that number. Okay, this brings us to a free cash flow margin here of 50.3%, which is a bit higher than where we're at right now. But again, based on these assumptions, this is what we're getting. As for the bear case, where everything can go wrong. Now, again, with the bear case, just because it's a bear case doesn't mean that you have to be, well, not reasonable with your assumptions. It needs to make sense. And so for it to make sense, of course, I'm still looking at 70% growth in revenue for the fiscal year. But then that growth does come down quite sharply. As well, AMD grows more, as every other big tech company out there maybe is happy with the chips that they're producing, and so they need NVIDIA less. Yes, this is the bear case. So this is what happens. And here, of course, you can see that EBIT margin is now under 60%. We're ending here at around 57%, which I know some will say that even this is too high. But look at the position that NVIDIA is in right now. For them to start losing an insane amount of pricing power, competitive power, whatever you want to name it, well, a lot of things need to go in the wrong direction. And yes, even if this is a bear case, you have seen, of course, the bear case price. It's 36.6% lower than when we're at today. And it's based on these types of assumptions. Free cash flow margins here, 46% or so. So yeah, it's not that this is going to be a company that will suddenly have extremely bad margins. No, it will still have extremely good margins, but based on the price that you're paying today, well, it's not good enough. That's the whole point here. The whole point of doing these types of exercises is seeing, okay, what is priced in? What am I willing to pay for? How much of the upside is a premium to I'm willing to pay that? Well, here you can clearly see that even with very, very high margins, whether it's EBIT or free cash flow, it is worth way less than what you're paying for it right now. That's the whole point. And then in the sensitivity tab, you can just have a quick look at, well, the terminal growth rate and then the WACC. You can see that right now we are right around here. So 3% terminal growth rate, 12% WACC. Some people will say, again, it's too high or it's too low. You can just look at the range here and then you'll quickly find out, oh, it's 3.5% terminal growth rate, 14% WACC or 8% WACC, whatever. You can play around with this as well. Well, don't change the numbers here. The numbers that you can change across the whole sheet are the blue numbers. And so now that you've seen the numbers, the assumptions, is it fair to say that NVIDIA is not expensive today? Is it fair to say that NVIDIA is cheap today? Let me know in the comment section below, right? Because right now, if we go and have a look at AMD, for example, AMD, of course, has also had quite some success over the last couple of years, maybe not as good as NVIDIA, but with AMD, you're of course paying a trailing PE here of 82.4 times and a forward PE of 28.6 times, although maybe that one is also a tiny bit lower. We can go and look at the pricing metrics here, so we get all the rest as well. And we're actually paying more than that. It's at 32.8 times. That's for the next 12 months. And then for fiscal year 27, that's 20.2 times. So you can clearly see that based on the current analyst expectations, well, earnings are going to go up substantially, which is why you're seeing that pricing multiple go down quite rapidly. But ask yourself this, why is the market willing to pay or willing to give AMD such a premium on forward-looking assumptions and not on NVIDIA? Of course, one argument might be that, yes, NVIDIA is already a $4.3 trillion company, AMD, $355 billion company. They've got those connections now with OpenAI and partnerships, contracts with OpenAI, with Meta. It's maybe easier for AMD to start seeing accelerated growth than it is for a company like NVIDIA. Okay, fair enough. But this doesn't counter the argument that NVIDIA should be priced at a higher multiple than what we've just seen based on the margin profile, the profitability, the current growth of that business, despite the size. And me as an AMD investor, I'm of course quite happy that I'm getting a higher premium from the market right now. Of course, this adds extra pressure on, well, AMD to execute and, well, make sure that the growth rates are there, whether it's revenue or earnings and margins. But I can't help myself to look at NVIDIA at the moment. I'm not planning on selling AMD, but you look at NVIDIA and you're like, okay, 6 months stock has done nothing. We've seen acceleration in growth. We've seen huge projections. We've looked at the bear, the bull, and the base case for the company. It makes sense. There is upside there. I don't see how NVIDIA will lose the top spot over the next couple of years, or at least even if it does lose a little bit, it will still be by far the number one player there. Started to think, okay, if you're looking for, let's say, a safer way to play this new AI world, why not just go with NVIDIA at $180 per share? And so this leads me back to GTC, more specifically the part that Grok with a Q, will play in NVIDIA's future. Because remember, in late 2025, I believe there was that announcement that NVIDIA is acquiring Grok for $20 billion. It's not really a full acquisition. It's acqui-hire plus a licensing deal that is worth around $20 billion. Now, you might have heard this quite a lot, right, over the last year or so, that, oh, NVIDIA is number one in training, but in inference, it's nowhere near. Well, it wasn't really true, but right now with this acquisition right here, NVIDIA is making sure that in the age of inference, well, it's still going to be the top dog. And so NVIDIA has licensed Grok 3 LPU technology. This represents the first non-GPU silicon ever in an NVIDIA rack. It offers 35 times better performance per watt for inference compared to previous iteration, and it's supposed to ship in Q3 2026 on Samsung's 4nm process. This deal is viewed as the Mellanox of inference. So Mellanox back then turned NVIDIA from a chip vendor into a networking powerhouse. Grok, with a Q, turns NVIDIA from a training vendor into an inference optimized platform. And by structuring this as a licensing asset deal rather than a full acquisition, NVIDIA effectively neutralized a rising competitor while sidestepping the antitrust hurdles that killed their ARM deal that was supposed to happen, for $40 billion or so. And so by combining the Vera Rubin NVLink 72, the GPUs, with the Grok 3, the LPUs, NVIDIA claims a staggering performance leap. Like we've said, 35 times higher inference throughput per megawatt for 1 trillion parameter models compared to the previous Blackwell generation, and 10x higher revenue opportunity per rack because the extreme speed allows data centers to serve more users simultaneously without adding power. Why is this such a big deal? Well, because, of course, with the rise of ASICs, companies like Broadcom, Cerebras would steal the inference market, or even AMD. By owning the LPU, NVIDIA has effectively closed the gap. Well, some might say that there wasn't really a gap to start with. Then the Grok hardware is fully integrated into CUDA. So here again, you have the software lock-in. It's not just CUDA, it's also NVIDIA Dynamo. Developers don't have to rewrite any code. The software automatically routes the work to the most efficient chip. And lastly, of course, we have to talk about margin preservation because, well, high-speed inference is a premium. NVIDIA is targeting a price point of roughly $45 per million tokens, allowing them to maintain high margins even as the inference economy grows, which leads me to these points right here. It's all about tokens per second per dollar. Jensen has talked about this more recently, the price of a factory versus the cost of the token. Right? You've probably heard this in the All-In podcast, talking about, oh, okay, you are saying that an inference factory is going to cost around $40 to $50 billion, while the others, the AMD, the ASICs companies can do it for much less, for 50% of the price. Well, he said, look, there is a fixed price for the data center, for the land, for the energy. That doesn't change in the deal. What does change in the deal, and this is why we are so-called pricing it at $50 billion, is this right here. There's the price of the factory and the cost of the tokens. Even at $50 billion compared to $20, $30 billion, NVIDIA, based on what they're saying, because of all of the efficiency, because of software, they can make all of this more efficient and make sure that your return on investment, even at $50 billion, is higher than those at $20, $30 billion. Because essentially it all comes down to literally this, the tokens per second per dollar. we are still very, very early in this whole revolution, whether you believe it or not, because eventually you will see a lot of new companies, a lot of new apps, a lot of new products and services. And if you want customers, billions of users, but customers to engage with these types of products and features on a daily basis that don't have to wait 10 seconds, 20 seconds, a minute, 2 minutes, 3 minutes, maybe sometimes a couple of extra minutes in order to get a response, whether it's because of a robot or whatever, you will need to optimize this as much as possible. And that's when this this thing right here, tokens per second per dollar, will matter the most. And so right now, purely looking at the stock, you can see that it's trying to go back above the 200-day moving average here on the daily. The 200-day sits at $179. We are literally 10 cents away from that. And so all in all, to conclude, it's pretty simple. If you want to play it safe while also having a lot of upside without losing too much sleep, I think NVIDIA at these prices right now, again, you're paying the same price for NVIDIA today that you paid for 6-7 months ago. Yet the company is, in my opinion, a better company today than it was 6-7 months ago. It has its hands in almost every big technological change here on this planet. And I do think that it will still have its hands in most of these things over the next couple of years, if not decades. Let me know what you think down in the comment section below. Is it a no-brainer? Is it your number one position? You don't like it? You have AMD, you have some others? Let me know down in the comment section below. Do check out fiscal.ai as well. See you all in the next one. Bye-bye.